Welcome to the deep dive. Today, we're going to tackle something that I think every new entrepreneur needs to know, and that is financial statements. But don't worry, we're going to ditch all the jargon and make this super practical for you. You're about to get a crash course in reading and understanding these reports, and it's all based on John and Tage Tracy's book, How to Read a Financial Report.
Think of this as your financial GPS as we decode those numbers and show you exactly how to use them to make smart decisions for your business.
Okay, so let's just jump right in. I know that the income statement is all about profit, but are there other financial reports that, as entrepreneurs, we should be watching?
Absolutely. While profit is super important, it's definitely not the whole story. You also need to understand the balance sheet and the statement of cash flows.
Okay.
Think of these three reports as your business's vital signs, so it's kind of giving you a complete checkup on the financial health.
So it's like a financial dashboard with different gauges showing me how my business is running.
You got it. The income statement is like your report card. It's showing how much money you made and spent over a specific period of time. It tells you if you're actually making money from your operations. The balance sheet, on the other hand, is more like a snapshot of your business's worth at a specific moment in time. It shows what you own, your assets, what you owe, your liabilities, and what's left over for you, the owner, which is your equity.
Okay, so assets, those are things like the cash I have in the bank, the equipment that I'm using, or maybe even a patent that I own.
You're exactly right. Think of it like this. Anything your company owns that has value is an asset.
Right.
Now, on the flip side, liabilities are what your business owes to others. This could be a loan from the bank, unpaid bills, or even taxes that you owe.
So if I buy a new computer for my business using a credit card, that computer's an asset, and the credit card balance is the liability.
You got it. Now, the third piece of the balance sheet puzzle is equity. This represents your ownership stake in the business, and it's basically what's left over for you after all the liabilities are subtracted from your assets. The balance sheet always, well, that balances because assets, liabilities, plus equity.
Okay, I'm starting to see how these pieces fit together. So if I invest more of my own money into the business, then my equity would go up.
Exactly. Your equity increases when you invest more, and it also grows when your business makes a profit. On the other hand, it decreases if you take money out of the business or if the business experiences losses. Understanding this equation is crucial because it helps you analyze your financing options. Do you need to take on more debt to grow, or can you fuel expansion through your profits?
That's a great point. I never even thought about the balance sheet as a tool for making decisions about financing. Now, let's demystify the income statement. I know it shows whether my business is profitable, but is there more to it than just looking at the sales numbers?
There's a lot more to it than just sales. Savvy entrepreneurs pay close attention to their expenses. Understanding where your money is going is key to figuring out how to boost that bottom line.
So it's not just about bringing in the money. It's about managing what goes out too. What are some of the key expenses that I should be watching on my income statement?
The income statement breaks down your expenses into categories. You'll see your cost of goods sold, which is the direct cost of creating or acquiring the products that you're selling.
Right.
For example, if you're selling handmade candles, your cost of goods sold would include the wax, the wicks, the jars, and any scents or dyes that you're using. Then there are your operating expenses, which are the costs of running your business day to day. This could include things like rent, utilities, marketing, and salaries.
So cost of goods sold is all about what it costs to make my product, and then operating expenses are the costs of keeping the lights on and the business running smoothly.
Precisely. And the income statement helps you to see how efficiently you're managing both types of expenses. Remember, just because you have a lot of sales doesn't mean that you're profitable. You could be spending more than you're making.
Ouch. That's not a good scenario.
Yeah.
So the income statement can help me to catch those potential problems early on.
Absolutely. Now, here's something that can trip up new entrepreneurs. You could have a great income statement showing a really healthy profit, but still find yourself short on cash.
Wait, how's that possible? I thought profit meant having more money.
That's where the statement of cash flows comes in. This report tracks the actual cash coming in and out of your business. You could make a ton of sales, but if your customers haven't paid you yet, you might not have the cash on hand to cover your bills.
That's scary. So the cash flow statement helps me avoid that nightmare by showing me where my cash is really going.
Exactly. It breaks down cash flow into three main categories: operating activities, investing activities, and financing activities.
Can you give me some examples of each of those?
Of course. Operating activities are the cash flows from your core business operations. Things like cash you receive from customers when they buy your products, and cash you pay out for expenses like rent and supplies. Investing activities involve buying or selling long-term assets for your business. This could be buying a new delivery van or selling an old piece of equipment you no longer use. Financing activities are all about how you raise money for your business. This could involve taking out a loan, getting an investment from someone, or even putting more of your own money into the company.
Okay, so the cash flow statement shows me the real money coming in and out, not just the sales and expenses that I've recorded on paper.
You got it. It's all about tracking that actual movement of cash, which is crucial for making sure that you can pay your bills and keep your business running smoothly.
This is starting to make a lot more sense. So now I've got these three reports. The income statement showing my profitability, the balance sheet showing my assets, liabilities, and equity, and my cash flow statement that's tracking that actual cash coming in and out.
Hmm.
What's really fascinating is how they're all connected, right?
You're catching on quickly. That's one of the most important things for entrepreneurs to understand. Any change on one of these statements is going to ripple through the others.
Okay.
For example, let's say you sell a product to a customer, but they don't pay you right away. You'd record the sale on your income statement, which would increase your revenue. But your cash flow statement wouldn't reflect that cash coming in until the customer actually pays. And on your balance sheet, you'd have an increase in accounts receivable, which is the money that customer owes you that's considered an asset.
Oh, so it's like a domino effect. One financial event can impact all three of these reports in different ways.
Exactly. And understanding these relationships is like having a superpower. You can spot potential issues early on, like maybe a cash crunch, even when you're profitable on paper, and make smarter decisions about how to manage your finances.
Okay, I'm starting to feel like a financial superhero.
Ah.
But how do we know what's considered good or healthy when we look at these reports? Are there any benchmarks that we can use?
That's where financial ratios come in. Think of them as your business's vital signs. They help you check its pulse and see if things are running smoothly or if they need a closer look.
So ratios help us translate those numbers into something that we can actually understand and use to make decisions.
Yeah.
Can you give me some examples of ratios that are particularly helpful for new entrepreneurs?
Absolutely. One that's really important is the current ratio. This measures your business's ability to pay its short-term bills. It's calculated by dividing your current assets, things that you can quickly turn into cash, by your current liabilities, bills that you need to pay soon.
Okay, so the current ratio is telling me if I have enough cash on hand to cover my immediate expenses, what's considered a healthy current ratio?
Generally, a ratio of 2 or higher is considered good.
Yep.
This means that you have twice as much in assets that can quickly be turned into cash as you have in upcoming bills. It essentially gives you some breathing room to handle those obligations without stressing.
That makes sense. So if my current ratio is below 2, I might need to take steps to improve my cash flow or reduce my short-term debts.
Exactly. The current ratio is a great early warning system for potential cash flow problems. Another key ratio to watch is the debt-to-equity ratio. This one measures how much of your business is financed by debt compared to equity.
Okay, so if I've taken out a lot of loans to start my business, my debt-to-equity ratio would be higher.
That's right. And while some level of debt is normal, and it can even be helpful for growth, a very high debt-to-equity ratio can be a red flag for potential lenders or investors. They might see it as a sign that your business is too risky.
So it's a balancing act between using debt strategically to fuel growth, but also keeping that ratio in check to show that I'm not overly reliant on borrowed money.
Exactly. Now let's talk about a ratio that's all about profitability. The return on sales. This one tells you how much profit you're making on each dollar of sales.
Okay, that sounds like an important one. So a higher return on sales means I'm making more profit from each sale.
You got it. And that means that you're managing your costs effectively and running an efficient business.
These ratios are starting to make so much more sense now. I can see how they can help me spot areas for improvement and track my progress over time.
They are really powerful tools, but it's important to remember that financial ratios are most meaningful when compared over time or against industry benchmarks.
So it's not just about looking at a single number. It's about seeing the trends and comparing myself to other businesses in my industry.
Precisely. By tracking your ratios over time, you can see if your financial health is improving or if you need to make adjustments. And by comparing them to industry averages, you can get valuable insights into how your business stacks up against the competition.
This is making me feel a lot more confident about understanding and using financial statements. But before we move on, I have one more question. Sometimes companies try to make their numbers look better than they really are, right?
Right. Unfortunately, that can happen. It's called financial engineering, and it often involves using what we call non-GAAP measures, which are basically calculations that don't follow standard accounting rules.
Okay, so as a new entrepreneur, how do I protect myself from being misled by these manipulated numbers?
That's where critical thinking and a healthy dose of skepticism come in. Don't just take the numbers at face value. Dig deeper, ask questions, and understand what's really going on behind those numbers. And of course, having a good CPA on your team can make a world of difference.
Speaking of CPAs, they're like a secret weapon for new business owners, right?
Absolutely. A good CPA can be an invaluable partner, helping you with everything from setting up your accounting system to deciphering those tricky financial statements.
So it's worth investing in that professional help to make sure that I'm on the right track.
Absolutely. They can save you time, money, and potential headaches in the long run. Now, before we dive into the nitty-gritty details of each financial statement, I want to emphasize one more thing. Don't be afraid of those footnotes.
I have to admit, footnotes are usually the part that I skip over. They seem so dense and technical.
I understand, but trust me, those footnotes can be gold mines of information. They're like the terms and conditions of financial statements, often revealing crucial details about a company's accounting methods and policies. This is especially important when you're comparing your business to others or trying to attract investors.
Okay, you've convinced me. No more skipping the footnotes.
Good. Because now we're going to take a closer look at each financial statement, starting with the balance sheet. Remember, this report gives you a snapshot of what your business owns and owes at a specific moment in time.
Okay, all right, let's break it down. What are the main components of a balance sheet?
Well, the balance sheet is based on a fundamental accounting equation. Assets, liabilities, plus equity. We already discussed what each of these terms means, but let's dive into some specific examples of assets that a new business might have.
Sounds good. I'm ready to get into the details.
Well, the most liquid asset is cash. This is the money your business has readily available in its bank accounts or on hand. Then there's accounts receivable, which is money that customers owe you for goods or services they've already received.
So accounts receivable is kind of like an IOU from a customer.
That's a good way to think about it. Then there's inventory. That's the raw materials, work in progress, and finished goods your business has on hand for sale.
Got it. So those are all assets that can be converted to cash relatively quickly. What about assets that are meant to be used in the business for a longer period of time?
Those are called long-term operating assets or fixed assets. These are things like property, plant, and equipment. So think buildings, machinery, vehicles, computers, and furniture.
And those assets are meant to be used over several years, not sold like inventory, right?
Exactly. Now, remember we talked about how intangible assets like patents and trademarks can also be considered long-term assets.
Right. They don't have a physical form, but can still be incredibly valuable to a business, especially in today's knowledge-based economy.
Exactly. Now, let's move on to the liabilities side of the balance sheet. These are obligations that your business owes to others.
So things like loans.
Loans are definitely a common liability, but there are others. Accounts payable is another big one. This represents the short-term obligations your business has to its suppliers for goods and services that you've purchased on credit.
So if I buy supplies from my business and haven't paid for them yet, that goes into accounts payable.
Exactly. Then there are what we call accrued expenses payable, which are expenses that you've incurred but haven't yet paid for. This could include things like salaries, rent, or utilities.
Okay, so those are all short-term liabilities that need to be paid relatively soon.
Mhm.
Are there long-term liabilities too?
Yes, long-term liabilities are obligations that are due more than a year out. These could include things like mortgages, bonds, or long-term loans.
Got it. So liabilities are basically any outstanding debts that my business has. Now, let's talk about equity. This is the owner's stake in the business, right?
Yes, equity is what's left over for the owners after all debts are paid.
So it's the value of the business that belongs to the owners.
Exactly. For corporations, equity is typically divided into two categories: capital stock and retained earnings.
Let's start with capital stock. What exactly is that?
Capital stock represents the money that investors have directly invested in the company by purchasing shares of stock.
Okay, so if I invest $10,000 in my own business by purchasing shares, my capital stock increases by $10,000.
That's correct. Now, retained earnings are a bit more nuanced.
Okay, I'm all ears. Explain retained earnings to me like I'm 5.
Imagine your business is a piggy bank. Retained earnings represent the portion of your business's profits that you've decided to keep in the piggy bank rather than taking out as dividends.
So it's essentially the accumulated profits that haven't been distributed to the owners.
You've got it.
Yeah.
Retained earnings are a key indicator of a company's financial strength and its ability to reinvest in its own growth.
Now, I know we're focusing on the balance sheet right now, but I'm curious, how do retained earnings connect to the income statement?
That's a great question, and it highlights that interconnected nature of these financial statements. Net income, which is the profit earned during a specific period, is added to retained earnings at the end of that period.
Okay.
So, as your business generates profits, your retained earnings will grow, which in turn strengthens your overall equity position on the balance sheet.
That makes sense. So the balance sheet isn't just a static snapshot. It's constantly being updated as the business operates and generates profits or incurs losses.
Exactly. The balance sheet provides a dynamic picture of your company's financial position at any given time. It's a vital tool for understanding your business's assets, liabilities, and the overall value that belongs to you as the owner.
This is all starting to make a lot more sense. Okay, so we've covered the balance sheet basics. Now let's shift our focus to the income statement. This is where we see the company's financial performance over a period of time, right?
That's right. The income statement, also known as the profit and loss statement, shows how much revenue your business generated and how much it spent to generate that revenue during a specific accounting period, which could be a month, a quarter, or a year.
So it's like a financial movie, showing the flow of revenue and expenses over time.
That's a great analogy. The basic structure of the income statement is pretty straightforward. It starts with revenue, which is the money your business earns from selling goods or services.
Okay, revenue first, then what?
Then you subtract the cost of goods sold, which is the direct cost associated with producing or acquiring the goods or services that you sell. This includes things like raw materials, direct labor, and manufacturing overhead.
So if I'm selling handmade jewelry, my cost of goods sold would include the cost of the beads, the metal, and my time spent making the pieces.
Exactly. Subtracting the cost of goods sold from revenue gives you your gross profit.
So gross profit is what's left over after covering the direct costs of producing my product.
Precisely. Now, from gross profit, you subtract your operating expenses. These are the expenses you incur to run your business, like rent, salaries, utilities, marketing, and advertising.
So those are the costs of keeping the lights on and the business running smoothly.
You got it. After subtracting operating expenses from gross profit, you get your operating income.
Okay, so operating income shows the profit from my core business operations. What's next?
Next, you subtract any non-operating expenses, such as interest expense on loans. Finally, you subtract your income tax expense to arrive at your net income, which is your bottom line profit.
Okay, I'm following you so far, but I can see how this could get pretty complex. Is there a way to simplify this for a new entrepreneur who's not an accountant?
Absolutely. One way to simplify it is to think of the income statement as a waterfall. You start with revenue at the top, and then you just subtract various expenses as you flow down the statement, ultimately arriving at your net income at the bottom.
Oh, that's a great visual. I can picture that. The money flowing down with each expense, taking a little bit away until we reach that final profit. It makes the process a lot easier to grasp.
Exactly. And by analyzing each line item on that waterfall, you can see where your money's going and identify areas where you might be able to cut costs or improve efficiency.
This is really helpful. I'm starting to see how all the pieces of the financial puzzle fit together. Okay, so we've covered the balance sheet and the income statement. Now let's dive into the statement of cash flows. This one tracks the actual cash coming in and out of the business, right?
You're exactly right. The statement of cash flows is all about cash, where it comes from, where it goes, and how much you have on hand at any given time. It's a critical report for understanding your business's liquidity and its ability to meet its financial obligations.
So even if my income statement shows a profit, my cash flow statement could reveal that I'm actually short on cash.
Exactly. Remember, the income statement includes non-cash items like depreciation, and it doesn't account for the timing of cash inflows and outflows.
Okay, so let's break down the statement of cash flows. What are the main sections?
It's divided into three main sections: cash flows from operating activities, cash flows from investing activities, and cash flows from financing activities.
Can you explain what each section covers?
Of course. Cash flows from operating activities focus on the cash flows that are generated from your core business operations. This includes cash received from customers, cash paid to suppliers, and cash paid for operating expenses like rent and salaries.
So it's all about the day-to-day cash transactions that keep the business running.
That's a great way to put it. Next, you have cash flows from investing activities, which involve the purchase and sale of long-term assets.
Okay.
For example, if you buy a new piece of equipment for your business, the cash outflow would be recorded in this section. And if you sell an old piece of equipment, the cash inflow would be recorded here.
Got it. So investing activities are all about the big ticket items that impact the business's long-term assets.
Exactly. Finally, we have cash flows from financing activities, which involve transactions with lenders and investors. This includes cash inflows from borrowing money, issuing stock, or receiving contributions from owners, as well as cash outflows for repaying loans, repurchasing stock, or paying dividends to shareholders.
Okay, so financing activities are all about how the business raises and uses capital.
Precisely. By analyzing each of these sections, you can get a clear picture of how your business is generating and using cash and identify potential cash flow issues before they become major problems.
This is so helpful. I'm starting to feel a lot more confident about understanding financial statements. Now, I know we talked about financial ratios earlier. Can you give me some more specific examples of ratios that are particularly relevant for new entrepreneurs?
Of course, one of the most important ratios for new businesses is the current ratio, which we discussed earlier. Remember, it's calculated by dividing current assets by current liabilities, and it tells you how well your business can cover its short-term obligations.
Right. A higher current ratio is generally better because it means you have more cushion to meet your short-term debts.
Exactly. Another key ratio is the debt-to-equity ratio, which measures the proportion of your business's financing that comes from debt compared to equity. It's calculated by dividing total debt by total equity.
Okay, so a higher debt-to-equity ratio means that the business is using more debt financing, which can be riskier, right?
That's right. While some level of debt is normal and can be healthy for a business, a high debt-to-equity ratio can make it difficult to obtain additional financing or weather economic downturns.
That makes sense in theory, but how does that play out in the real world?
Yeah.
Have you seen companies manipulate these ratios to make themselves look better to lenders or investors?
It definitely happens. Companies might try to what we call window dress their financials by temporarily reducing their debt right before applying for a loan, or by structuring transactions in ways that make their equity look larger. That's why it's important to not just look at the ratios in isolation, but to understand the context behind them and look for any red flags.
So it's like being a financial detective. We need to look for clues that might reveal a different story than the one that the numbers are initially telling us.
Exactly. And this is where having a good CPA on your side can be invaluable. They're trained to spot those inconsistencies and help you understand the true financial health of a business.
Okay. I'm definitely adding find a good CPA to my to-do list. Now, let's talk about profitability ratios. These ratios measure how effectively your business is generating profits, right?
You're exactly right. One of the most common profitability ratios is the return on sales, which we touched on earlier. Remember, it's calculated by dividing net income by sales revenue.
So it tells you how much profit you're making for every dollar of sales.
Exactly. A higher return on sales, it's generally better because it indicates that you're managing your costs effectively and generating more profit from your sales.
These ratios are starting to make so much more sense now. Are there any other ratios that are particularly helpful for new entrepreneurs?
Yes. Another important ratio is the inventory turnover ratio, which measures how quickly your business is selling its inventory.
Okay.
It's calculated by dividing the cost of goods sold by the average inventory.
So a higher inventory turnover ratio means that you're selling your inventory more quickly, which is generally a good thing, right?
That's right. A higher inventory turnover ratio means you're not tying up too much cash in inventory and that you're managing your inventory effectively. However, it's important to note that a very high inventory turnover ratio could indicate that you're not carrying enough inventory to meet customer demand, which could lead to lost sales.
So it's all about finding that right balance, like so many aspects of business.
Exactly. These ratios are just a few examples of the many tools that are available to help you analyze your business's financial performance. By understanding these ratios and how they relate to your specific business, you can gain valuable insights into your operations and make more informed decisions.
This is all incredibly valuable information. I feel like I'm finally starting to crack the code of financial statements, but I know there's still a lot to learn. What are some common mistakes that new entrepreneurs make when it comes to financial statements?
One common mistake is not paying enough attention to their financial statements. Many entrepreneurs get so caught up in the day-to-day operations of their business that they neglect to review their financial statements regularly.
Yeah, it's easy to get caught up in the whirlwind of running a business and let those reports pile up.
It happens all the time. But remember, your financial statements are a vital source of information about your business's health. They can help you to identify potential problems early on, track your progress, and make more informed decisions.
Okay, so regularly reviewing our financial statements is crucial. What are some other common pitfalls to avoid?
Another mistake is not understanding the information in their financial statements. It's not enough to just glance at the numbers. You need to understand what those numbers mean and how they relate to your business.
So it's not just about crunching numbers. It's about understanding what those numbers are telling us about the business.
Precisely. Take the time to learn about the different financial statements, the key ratios, and how to interpret the information. Don't be afraid to ask your CPA for help. They're there to guide you.
That's excellent advice. Any other common mistakes that you see new entrepreneurs making?
Another one is not using their financial statements to make informed decisions. Your financial statements are a powerful tool that can help you make strategic decisions about your business.
So instead of just filing them away, we need to actively use them to guide our business decisions.
Absolutely. Use your financial statements to set goals, track your progress, identify areas for improvement, and make informed decisions about pricing, inventory, marketing, and more.
Wow, I'm realizing that financial statements are so much more than just numbers on a page. They're really a roadmap for success.
You're getting it. Financial literacy is essential for any entrepreneur who wants to build a successful and sustainable business.
This has been a fantastic deep dive into the world of financial statements. I feel so much more knowledgeable and empowered to take control of my business finances. But before we wrap up this section, I have one more question. We've talked a lot about the importance of CPAs. How do I find a CPA who's a good fit for my business?
That's a great question. First, look for a CPA who has experience working with businesses in your industry. This will ensure they understand the specific challenges and opportunities that you face.
So someone who speaks my language and gets my business.
Exactly. Second, consider their communication style and personality. You want to work with someone that you trust and feel comfortable communicating with.
Someone who can explain things clearly and who I can ask questions to without feeling intimidated.
Absolutely. Third, get referrals from other business owners or trusted advisors. And finally, don't be afraid to interview several CPAs before making a decision.
That's great advice. It's like finding a business partner. You want to make sure that it's the right fit.
You're exactly right. Finding the right CPA is a crucial step for any new entrepreneur. They can be a valuable asset as you navigate the financial complexities of starting and growing your business.
This has been such an enlightening deep dive into the world of financial statements. We've covered a lot of ground, from the basics of balance sheets and income statements to the intricacies of cash flow statements and financial ratios. But I know we're just scratching the surface here.
There's always more to learn, and that's the exciting part. The key is to continue to educate yourself about financial management and to actively use your financial statements as a tool for success.
Before we move on to the next part of our deep dive, I want to leave our listeners with a thought-provoking question. If you could track one non-financial metric that would be a leading indicator of your business's success, what would it be? Keep that in mind as you continue to build your business empire.
That's a great question to ponder. It really makes you think about the core drivers of success for your unique business. Now, shifting gears a bit, let's dig deeper into something you've probably heard before, and that's the saying, cash is king.
Oh, yeah. I've definitely heard that phrase thrown around a lot. It seems pretty straightforward. You need cash to pay your bills, but I'm guessing there's more to it than that.
You're right. It is about paying the bills, but it's also about so much more. Strong cash flow gives you flexibility, it gives you options, and it lets you invest in those new opportunities, weather those unexpected storms, and yes, it even lets you sleep better at night.
So it's like having a financial safety net for your business. Knowing that you have that cash cushion can give you that peace of mind and the confidence to make bold moves.
Exactly. Without enough cash, even a profitable business can find itself in trouble. Imagine having a ton of orders, but not enough cash on hand to buy the supplies that you need to fulfill them. That's why understanding how to manage your cash flow effectively is absolutely essential for any entrepreneur.
I can see why this is especially crucial for new businesses. You're just starting out. You're often operating on tight margins, and you might not have a lot of financial reserves built up.
You're spot on. A cash crunch can quickly derail even the most promising startup. That's why it's so important to monitor your cash flow carefully and take steps to improve it if needed.
Okay, so let's talk tactics. What are some practical strategies that entrepreneurs can use to improve their cash flow management?
One of the most effective strategies is to speed up your collections.
Yeah,
The faster you can collect money from your customers, the more cash you'll have on hand to cover your expenses and reinvest in growth.
that makes sense. But how do we actually do that without, becoming a nuisance to our customers? We don't want to start hounding people for payments right away.
There are definitely more tactful ways to approach it. You can offer early payment discounts, clearly outline payment terms and deadlines in your contracts, send invoices promptly. You can also leverage technology to make things easier, using online payment platforms, for example, that allow customers to pay you quickly and securely.
Oh, those are great ideas. It's about making it as easy as possible for customers to pay and even giving them a little incentive to do it quickly. What about on the expense side? Any tips for managing those cash outflows?
Absolutely. Start by taking a close look at all of your expenses and see where you can trim the fat without sacrificing quality or hindering growth. This might involve negotiating better deals with your suppliers, exploring cost-effective alternatives for things like software or marketing tools, and eliminating any unnecessary subscriptions or services that you're not really utilizing fully.
So it's all about being mindful of every dollar that goes out the door and finding ways to be more efficient.
Exactly. Another important strategy is to carefully manage your inventory. Avoid overstocking items that are slow to sell, as this ties up valuable cash that could be used elsewhere.
Right. We talked about the inventory turnover ratio earlier. That's a great metric to keep an eye on to make sure that we're not uh, sitting on a mountain of unsold products.
You got it. And finally, don't be afraid to seek outside financing if needed. This could involve a line of credit, a small business loan, or even an investment from angel investors or venture capitalists.
So securing additional funding can provide a much-needed cash infusion to fuel growth or maybe help to bridge any gaps in cash flow.
Precisely. But remember, any form of financing comes with its own costs and obligations. Loans have interest payments, and taking on investors means giving up some ownership in your company. It's important to weigh the pros and cons carefully before making any decisions.
Now, I know we're diving deep into cash flow right now, but I'm curious, how does cash flow tie back to the income statement and the balance sheet? I'm starting to see all these connections between the reports.
That's a great observation. It shows you're really starting to understand how these financial statements actually all work together. Remember, net income, which is the bottom line of your income statement, doesn't always equal your cash flow.
Wait, can you explain that a little bit more? Why wouldn't net income be the same as the cash that I have on hand?
Well, it comes down to the timing of cash flows and the fact that the income statement includes some non-cash items like depreciation. Let's say you sell a large piece of equipment for your business. You'd record a gain on the sale on your income statement, but the actual cash from that sale might not hit your bank account until later.
Okay, so there's a lag between when the transaction is recorded on the income statement and when the cash actually changes hands.
Exactly. And that's where the statement of cash flows comes in. It bridges that gap by showing you the actual cash inflows and outflows during a specific period.
So by looking at all three statements together, I can get a much more accurate picture of my business's financial health.
You've got it. It's like having a 3D view of your finances. You can see what's happening on paper, which is the income statement, what your business is worth at a specific point in time, which is the balance sheet, and the actual cash flowing in and out, which is that cash flow statement.
This is making me think about something else that we discussed earlier, financial engineering, and how companies sometimes manipulate their numbers to make things look better than they actually are. It seems like a company could potentially manipulate its cash flow too, right?
Unfortunately, yes. Companies might try to inflate their cash flow by delaying payments to suppliers or selling off assets to generate a quick influx of cash, or even engaging in more complex schemes.
So how do we, as savvy entrepreneurs or investors, spot these red flags and protect ourselves?
Well, it all starts with a healthy dose of skepticism. Don't just take the numbers at face value. Dig deeper, ask questions, and compare the company's cash flow statement to its income statement and balance sheet. Look for any inconsistencies or unusual trends that don't really add up.
So it's all about being a financial detective and looking for clues that might reveal a different story than what's being presented.
Exactly. And remember, those footnotes that we talked about earlier can be extremely valuable. They often provide additional context and details about the company's accounting practices that might not be readily apparent in the main financial statements.
Okay, so we're paying attention to footnotes, analyzing trends, and looking for any inconsistencies. Any other tips for spotting potential financial manipulation?
Pay close attention to what we call non-GAAP measures. Remember, these are calculations that don't follow standard accounting rules and are often used to present a more favorable picture of a company's financial performance.
So if I see terms like uh, adjusted EBITDA or pro forma results, warning lights should start going off.
You got it. Always ask yourself, why is the company using non-GAAP measures, and what are they really trying to achieve by presenting their financial information this way? Are they trying to hide something or simply highlight a specific aspect of their performance?
This is all really helpful. I feel like I'm learning how to read between the lines of financial statements and not just take everything at face value. Now, I know we've talked a lot about the importance of having a good CPA on our team, but are there any other financial professionals who can be valuable resources for new entrepreneurs?
Absolutely. Financial advisors, business coaches, and even experienced mentors can provide valuable guidance and support as you navigate the financial complexities of starting and growing your business. They can help you to develop a solid financial plan, make smart investment decisions, and even connect you with potential investors.
So it's about building a team of trusted advisors who can help us make informed financial decisions and avoid costly mistakes.
Exactly. You don't have to be a financial expert yourself, but you do need to surround yourself with people who are. They can be your sounding board, your cheerleaders, and your guides as you navigate the ups and downs of entrepreneurship.
Now, before we move on to the next part of our deep dive, I want to shift gears for a moment and talk about a topic that can be a bit sensitive, but is so important for entrepreneurs to understand, and that is financial reporting fraud.
It's something that we've kind of touched on throughout this episode, but I think it deserves a deeper dive.
I agree. Financial reporting fraud, also known as accounting fraud, can have devastating consequences for businesses, investors, and, the overall economy.
So let's start with the basics. What exactly is financial reporting fraud?
It's essentially the intentional manipulation of financial statements to deceive investors, creditors, or other stakeholders.
So it's like, cooking the books to make things look better than they actually are.
Exactly. Companies might overstate their revenues, understate their expenses, or even hide liabilities to paint a rosier picture of their financial health and mislead investors or lenders.
Why would a company do this? What's the motivation behind financial reporting fraud? Well, there are several motivations, and they often stem from greed or pressure. They might be trying to meet those unrealistic earnings expectations, boost their stock price, secure financing that they wouldn't otherwise qualify for, or even cover up some illegal activities.
So it's about deceiving others for personal gain.
Unfortunately, that's often the case. But it's important to remember that financial reporting fraud can also be the result of incompetence, negligence, or a lack of proper internal controls. It's not always a deliberate act of malice, but the consequences can be just as damaging.
So it's not always a deliberate act of malice. It could just be a case of not having the right systems in place to prevent errors or catch them early on.
You're exactly right. That's why having strong internal controls, proper oversight, and ethical leadership is so critical. A strong ethical culture can deter employees from engaging in fraudulent activities and encourage them to report any suspicious behavior that they observe.
Okay, so we know that financial reporting fraud can happen, whether intentionally or unintentionally. What are some red flags that entrepreneurs or investors should be on the lookout for?
There are several warning signs that can indicate potential financial reporting fraud. Keep an eye out for things like aggressive revenue recognition practices, unusual or complex transactions, significant related party transactions, and weak internal controls.
Those are some pretty technical terms. Can you break those down for us in simpler terms?
Of course, aggressive revenue recognition means that a company is recording revenue before it's actually earned or realizable. For example, they might book a sale before the product has actually been shipped or the service has been fully rendered.
Oh, so they're basically jumping the gun on recording revenue to inflate their numbers and make themselves look more profitable than they really are.
Exactly. Unusual or complex transactions can also be a red flag. These are transactions that are outside the normal course of business and are often designed to obscure the true nature of the transaction or maybe to move money around in a way that's difficult to track.
So it's about creating a smoke screen to hide what's really going on.
That's a good way to think about it. Significant related party transactions can also be a warning sign. These are transactions between a company and entities that are closely related to it, such as executives, directors, or major shareholders.
So it's like doing business with your friends and family, which can create conflicts of interest and opportunities for abuse.
Exactly. It's important to scrutinize these transactions carefully to ensure that they're legitimate and conducted at a fair market value. And finally, weak internal controls are a major risk factor for financial reporting fraud. Internal controls are the policies and procedures that a company puts in place to ensure the accuracy and reliability of its financial reporting. If those controls are weak or non-existent, it creates opportunities for fraud to occur.
This is all making me think back to our discussion about the importance of having a good CPA. They play a critical role in detecting and preventing financial reporting fraud, right?
You're absolutely right. CPAs are trained to look for red flags and to audit financial statements to ensure their accuracy and compliance with accounting standards. They act as those independent watchdogs to protect investors and creditors from fraudulent activities.
Oh, it's like having a financial guardian angel looking out for our interests.
That's a great way to think about it. But it's important to remember that even the best CPAs can be fooled by sophisticated fraud schemes.
So we can't just blindly rely on CPAs. We need to be vigilant ourselves and use our own critical thinking skills to assess the information that we're given.
Exactly. Being financially literate and staying informed are your best defenses against financial reporting fraud.
This has been a fascinating and somewhat sobering deep dive into the world of financial reporting fraud. It's clear that this is a serious issue that entrepreneurs and investors need to be aware of.
You're absolutely right. Financial reporting fraud can have devastating consequences, not just for the companies involved, but for the entire financial system. That's why it's so important to be vigilant, to ask questions, and to demand transparency and accountability.
Okay, now that we've covered the serious stuff, let's shift gears again and talk about a topic that's a bit more lighthearted, but still incredibly important for entrepreneurs, and that is financial ratios.
Ah, yes. Financial ratios are like a secret decoder ring that can unlock valuable insights into your business's performance. They help you make sense of the numbers and identify areas for improvement.
I love that analogy. So it's not just about crunching numbers, it's about using those numbers to tell a story about our business and help us make those strategic decisions.
Exactly. Financial ratios help you to translate that raw data into meaningful information that can guide your decision-making. They can tell you if you're pricing your products effectively, if you're managing your inventory efficiently, or if you're taking on too much debt.
Okay, I'm ready to learn how to decode. What are some of the key ratios that entrepreneurs should be focusing on?
Well, we've already discussed several important ones: the current ratio, the debt-to-equity ratio, the return on sales, and the inventory turnover ratio. But let's explore a few more that can be particularly helpful for new businesses.
Oh, I'm all ears. I'm always looking for new tools and strategies to help me run my business more effectively.
One important ratio is the gross profit margin, which measures the profitability of your products or services before considering operating expenses. It's calculated by dividing gross profit by revenue.
Okay, so it tells me how much profit I'm making on each dollar of sales after covering the direct costs of producing my product or service.
You got it. A healthy gross profit margin is essential for any business because it provides the foundation for covering your operating expenses and generating a net profit.
So the higher the gross profit margin, the better.
Generally, yes. A higher gross profit margin means you have more room to cover your other expenses and ultimately make a profit. But it's important to consider your industry and pricing strategy as well. Some industries naturally have lower gross profit margins than others.
Makes sense. What about ratios that help us understand our business's efficiency? Always
Yeah.
looking for ways to streamline operations and, do more with less.
That's a great goal. One ratio that can help you assess your efficiency is the accounts receivable turnover ratio, which we touched on earlier. Remember, it measures how quickly you're collecting money from your customers.
Right. And a higher accounts receivable turnover ratio means that we're collecting that cash more quickly, which is great for our cash flow. We talked about strategies for improving collections earlier, like offering early payment discounts and using online payment platforms.
Exactly. Those strategies can have a direct impact on your accounts receivable turnover ratio and your overall cash flow. Another helpful ratio is the asset turnover ratio, which measures how efficiently you're using your assets to generate sales. It's calculated by dividing revenue by total assets.
Oh, okay. So it tells me how many dollars of sales I'm generating for every dollar of assets that I have.
Precisely. A higher asset turnover ratio indicates that you're using your assets effectively to generate revenue. For example, if you invest in a new piece of equipment that allows you to produce more products or serve more customers, you should see an improvement in your asset turnover ratio.
These ratios are starting to feel like superpowers. By understanding them, we can really unlock those valuable insights into our business's performance.
You're catching on quickly. Now remember, financial ratios are most meaningful when compared over time or against industry benchmarks.
So it's not just about looking at a single number in isolation. We need to see how it's trending over time and how it compares to other businesses in our industry.
Exactly. By comparing your ratios over time, you can track your progress and identify areas for improvement. And by comparing your ratios to those industry benchmarks, you can see how you stack up against your competitors. Are you outperforming them in key areas like profitability or efficiency, or do you have some work to do to catch up?
Oh, this is all starting to click. Financial ratios are like a financial fitness tracker for our business. We can use them to monitor our progress, identify areas for improvement, and make adjustments to get in better financial shape.
I love that analogy. Just like a fitness tracker helps you monitor your physical health and make adjustments to improve it, financial ratios help you to monitor your financial health and make adjustments to optimize your business's performance.
This has been such a fantastic deep dive into the world of financial ratios.
Yeah.
I feel like I have a whole new set of tools to analyze my business and make more informed decisions.
I'm so glad to hear that. Remember, financial literacy is an ongoing journey. There's always more to learn, and the business world is constantly evolving.
Okay, now that we've explored the power of financial ratios, let's shift gears again and talk about a topic that can be a bit overwhelming for new entrepreneurs. Footnotes to financial statements.
Footnotes are kind of like the fine print of financial statements, and while they might not be the most exciting read, they often contain crucial information that can really impact your understanding of a company's financial position and performance.
So we can't just skip over those footnotes, even though they can be a bit, dense and technical.
You're exactly right. Footnotes provide important context and details that can really help you interpret those numbers in the main financial statements. They can shed light on the company's accounting policies, significant accounting estimates, debt obligations, lease agreements, and even related party transactions.
Okay, I'm ready to dive into the world of footnotes. What kind of information can we find in these mysterious documents?
Footnotes typically include information about a company's accounting policies, significant accounting estimates, details about debt obligations, information about leases, breakdowns of certain expenses, and disclosures about related party transactions.
Whoa, that's a lot of information. Can you give me some specific examples of why this information might be important? I'm trying to understand how those footnotes can actually make a difference in my decision-making.
Of course. Let's say you're looking at a company's balance sheet and you notice a significant amount of long-term debt. Well, the footnotes might provide details about the interest rates, the maturity dates, and the covenants associated with that debt. This information can really help you assess the company's financial risk and its ability to meet those debt obligations.
So those footnotes can reveal important details that aren't apparent in the main financial statements. They're like that behind-the-scenes look at the company's financial dealings.
Exactly. Or let's say you're analyzing a company's income statement and you see a large increase in revenue. The footnotes might reveal that this increase is due to a change in the company's revenue recognition policy. This information can help you determine whether that revenue growth is sustainable or whether it's a one-time blip due to an accounting change.
Okay, so the footnotes can help us understand the context behind the numbers and make more informed assessments.
Precisely. They provide a deeper dive into the company's financial position and performance, helping you see beyond the headlines and really get a more complete picture.
This is making me think about our earlier discussion about financial engineering and the use of non-GAAP measures. Do footnotes play a role in shedding light on those practices as well?
You're spot on. Footnotes often provide reconciliations between GAAP and non-GAAP measures, explaining the adjustments that were made and the reasons for those adjustments. This information can really help you understand the company's true financial performance and avoid being misled by those overly optimistic non-GAAP numbers.
So even though footnotes might seem like those dry and technical documents, they can actually be a treasure trove of valuable information. They can help us to make more informed decisions, whether we're running our own businesses or considering investing in other companies.
You're exactly right. They're like a hidden bonus level in a video game where you can find all sorts of secrets and power-ups.
I love that analogy. It makes footnotes seem a lot more exciting.
That's the goal. Financial literacy doesn't have to be boring.
This deep dive into the world of footnotes has been incredibly enlightening. I'm realizing that these seemingly insignificant documents can actually be incredibly important for understanding a company's financial story.
You're absolutely right. By taking the time to read and understand the footnotes, you're really gaining valuable insights that can help you make more informed decisions, whether you're an entrepreneur, an investor, or just someone who wants to be more financially savvy.
Okay, now that we've explored the hidden depths of footnotes, let's shift gears again and talk about a topic that's particularly relevant in today's dynamic business environment, and that is intangible assets.
Intangible assets are often the most valuable assets that a company owns, but they can also be the most difficult to value.
Okay, remind me again, what exactly are intangible assets? We touched on them earlier, but I'd love a refresher.
Intangible assets are assets that don't have a physical form, but still hold significant value for a business. So think things like brands, patents, copyrights, trademarks, customer lists, and even goodwill.
So it's all about the things that you can't touch, but that can make or break a business.
Exactly. In today's knowledge-based economy, intangible assets are often the key drivers of a company's success.
That makes sense. In the past, physical assets like factories and equipment were often the most important. But now it's all about ideas, innovation, and brand recognition. A strong brand or a groundbreaking patent can be worth more than a building full of machinery.
You're exactly right, and that shift has made accounting for intangible assets more complex and challenging.
Why is that? What makes intangible assets so tricky to account for?
Well, for starters, they're often difficult to value. Unlike physical assets, which have a clear market value, the value of intangible assets is often subjective, and it can fluctuate significantly based on factors like market conditions, competition, and even consumer sentiment.
So it's not as simple as looking up the price of a piece of equipment.
Yeah.
You have to use a lot more judgment and estimation when valuing intangible assets.
You're exactly right. And that subjectivity creates opportunities for manipulation and even fraud.
Oh no. We're back to those financial shenanigans again. How can we, as savvy entrepreneurs or investors, protect ourselves from being misled by companies that might be playing fast and loose with their intangible asset valuations?
That's a great question. The first step is to be aware of the risks. Understand that intangible asset valuations can be highly subjective and that companies might be tempted to inflate those valuations to boost their financial performance.
So we're approaching intangible asset valuations with a healthy dose of skepticism.
Exactly. The next step is to carefully scrutinize the footnotes to the financial statements. Look for detailed disclosures about how the company arrived at its intangible asset valuations, the assumptions it used, and any independent appraisals that were conducted.
So we're not just taking the company's word for it. We're looking for evidence to support those valuations and making sure they're not just pulling numbers out of thin air.
You got it. It's also important to consider the company's overall financial health and its industry. A company with a strong track record of profitability and a dominant market position is more likely to have valuable intangible assets than a struggling company in a declining industry.
So context is key. We're looking at that big picture and not just focusing on a single number in isolation.
Exactly. Intangible asset valuations are just one piece of the financial puzzle. To make informed decisions, you really need to consider all the available information and use your own judgment and critical thinking skills.
This deep dive into the world of intangible assets has been fascinating. I'm starting to appreciate just how important these assets are in today's business environment, but also how challenging they can be to account for and value.
You're absolutely right. Intangible assets are a complex and evolving area of accounting. But by staying informed and using those critical thinking skills, you can navigate these complexities and make more informed decisions.
Okay, now that we've explored the world of intangible assets, I want to shift gears again and talk about something that's incredibly important for entrepreneurs who are looking to grow their businesses: securing financing.
Securing financing is often a make or break moment for entrepreneurs. It can be the fuel that propels your business to new heights or the obstacle that holds you back.
So it's all about finding the right type of financing at the right time and having a solid plan in place to convince those lenders or investors that our business is worth the investment.
You're exactly right. And the first step is to understand your financing needs. How much money do you need? What will you use it for? How long will it take you to repay it? What kind of return can investors expect?
Okay, so we need to start with a clear plan. We can't just go out and ask for money without knowing how much we need, what we'll do with it, and how we'll generate a return.
Exactly. A well-thought-out financial plan will not only guide your financing decisions, but also make you much more attractive to those potential lenders or investors. They want to see that you've done your homework and that you have a clear vision for your business's future.
Once we have that plan in place, what are some common types of financing for new businesses? Where can we go to find that much needed capital?
Well, one common option is debt financing, which involves borrowing money from a lender, such as a bank or credit union.
So it's like getting a loan for your business, similar to how individuals get mortgages or car loans.
Exactly. Debt financing typically comes with interest payments and a repayment schedule.
Got it. So you're essentially renting money from the lender and paying them back over time with interest. What about equity financing? How does that work?
Another common option is equity financing, which involves selling a portion of your business to investors in exchange for cash.
So you're giving up some ownership of your business in exchange for funding.
Exactly. Equity investors typically don't expect to be repaid like lenders, but they do expect to share in the profits of the business. They're taking a risk by investing in your company, and they expect to see a return on that investment.
Okay. So debt financing is like renting money, and equity financing is like selling a piece of your business. Are there other types of financing available to entrepreneurs, maybe some that don't involve taking on debt or giving up equity?
Absolutely. There are many creative financing options available, such as crowdfunding, grants, and even bartering.
Crowdfunding. That's when you raise money from a large group of people, often online, right? I've seen some amazing success stories of businesses getting funded through platforms like Kickstarter and Indiegogo.
That's right. It's a great option for entrepreneurs who are just starting out and may not have access to traditional financing sources. It's also a great way to build a community around your product or service and to get valuable feedback from potential customers.
What about grants? Aren't those free money?
Grants can be a fantastic source of funding, but they're often very competitive and come with very specific requirements and restrictions. You'll need to carefully research those grant opportunities to find ones that align with your business and be prepared to put together a compelling application.
Got it. So free money isn't always easy to come by. What about bartering? How does that work as a financing option?
Bartering involves exchanging goods or services for other goods or services. It's a great way to conserve cash and build relationships with other businesses.
So instead of paying for something with cash, you could trade something of value that you already have. For example, if I'm a web designer, I could trade my services for accounting help from a CPA.
Exactly. It's all about getting creative and finding solutions that work for your business.
Now, I know we're focusing on securing financing, but I'm curious, how does this tie back to the financial statements we've been discussing? Do potential lenders or investors look at those reports when deciding whether to fund a business?
Absolutely. Financial statements are a critical part of that due diligence process for any potential lender or investor. They want to see how your business is performing, its financial health, and its ability to generate cash flow and repay its obligations.
So it's not just about having a great business idea or a charismatic pitch. You need to back it up with solid financial statements that show you're managing your money responsibly and that your business has the potential to generate a return for investors.
You're exactly right. Financial statements are your business's financial resume. They tell the story of your company's performance, and they provide potential lenders or investors with the information that they need to assess the risk and potential return of their investment.
That makes sense. So we need to make sure that our financial statements are accurate, up to date, and presented in a clear and compelling way.
Exactly. And don't be afraid to use those statements to tell your business's financial story. Highlight your successes, explain any challenges, and be transparent about your financial goals. Lenders and investors are looking for businesses with a clear vision and a solid plan for achieving their goals.
This is all really helpful. I'm starting to see how financial statements are not just a reporting requirement, but a powerful tool for securing financing and growing our businesses.
You're getting it. Financial literacy is essential for any entrepreneur who wants to build a successful and sustainable business.
This deep dive into the world of financing has been incredibly informative. I feel much more prepared to navigate that process of securing funding for my business.
I'm so glad to hear that. Remember, securing financing is a journey, not a destination. It's an ongoing process that requires planning, preparation, and persistence. Don't be discouraged if you don't get funding right away. Use each experience as a learning opportunity and keep refining your pitch and your financial plan.
Now, before we move on to the final part of our deep dive, I want to take a moment to address a topic that can be a bit daunting, but is so important for entrepreneurs to understand, and that is taxes.
Taxes are an unavoidable reality for any business owner, but by understanding the basics and planning ahead, you can minimize your tax liability and keep more of your hard-earned money.
Okay, so let's start with the basics. What are the main types of taxes that entrepreneurs need to be aware of?
Well, the specific taxes that you'll owe will depend on your business structure, your industry, and your location. But some common types of taxes include income tax, sales tax, payroll tax, and property tax.
Let's start with income tax. I know individuals pay income tax on their earnings, but do businesses pay income tax too? I'm guessing the answer is yes, but I'm curious how it works.
Yes. Businesses do pay income tax on their profits, but the way it's calculated and paid depends on your business structure. For example, sole proprietorships and partnerships report their business income and expenses on their individual tax returns. So their business income is essentially taxed as personal income. Corporations, on the other hand, are considered separate legal entities, and they file their own corporate tax returns.
Got it. So the business structure impacts how income tax is calculated and paid.
Exactly. It's one of the many factors to consider when choosing a business structure. Now let's talk about sales tax. Sales tax is a tax on the sale of goods and services, and it's usually collected by the retailer and passed on to the government.
So when I buy something at a store, that sales tax is just added to the price.
That's right. As a business owner, you might be required to collect sales tax from your customers and remit it to the government. The rules and rates for sales tax vary depending on the state and even the city where your business operates, so it's important to research the specific requirements for your location.
Okay, so sales tax is collected from customers at the point of sale and then passed on to the government. What about payroll tax? Is that something that I need to worry about if I have employees?
Yes, payroll tax is a tax on wages and salaries that are paid to employees. As an employer, you are responsible for withholding payroll taxes from your employees' paychecks and paying those taxes to the government.
So I'm essentially acting as a tax collector for the government.
That's a good way to think about it. Payroll taxes fund important social programs like Social Security and Medicare, so it's important to make sure that you're calculating and withholding those taxes correctly. The IRS has detailed guidelines and resources to help employers understand their payroll tax obligations.
Okay, so payroll taxes are a crucial part of being an employer and ensuring that we're fulfilling our legal obligations. What about property tax? Is that something that applies to businesses as well?
Yes, property tax is a tax on real estate and personal property, such as buildings, land, and equipment.
So if my business owns a building or a piece of land, I might be required to pay property taxes on those assets.
You're exactly right. Property taxes are typically assessed by local governments, and they're used to fund local services like schools, roads, and parks. The rates and rules for property taxes vary significantly from one location to another, so it's important to research the specific requirements for your area.
This is all starting to make more sense. Taxes can seem complicated, but by understanding those main types and how they apply to our businesses, we can be better prepared and avoid any surprises come tax season.
You're absolutely right. And remember, it's always a good idea to consult with a tax professional to make sure that you're complying with all the applicable tax laws and regulations. They can help you minimize your tax liability and avoid those costly penalties.
That's great advice. It's like having a tax navigator to guide us through that complex world of taxes. They can help us to find those deductions and credits that we might not even know about and make sure that we're taking advantage of all the legal ways to reduce our tax burden.
Exactly. Taxes can be a headache for entrepreneurs, but with the right guidance and planning, you can manage them effectively and focus on what you do best, building your business.
This has been a fantastic deep dive into the world of taxes. I feel much more informed and empowered to tackle this important aspect of running a business. And I know we've covered a lot of ground already, from deciphering those sometimes intimidating financial statements to understanding cash flow and financial ratios. But I want to touch on one more topic that's often overlooked, but is so crucial for building a successful and sustainable business, and that is ethics.
Ethics are the foundation of any successful business. They guide our decisions, they shape our culture, and they ultimately determine our reputation in the marketplace.
I completely agree. It's not just about making a profit, it's about doing business the right way, building that trust with our customers and our employees, and creating a company that we can all be proud of. But ethics can sometimes feel like a vague concept. What are some specific ethical principles that entrepreneurs should strive to uphold?
Well, some fundamental ethical principles include honesty, integrity, fairness, respect, responsibility, and loyalty.
Those are all fantastic qualities. But how do those principles translate into real-world business practices? Can you give me some concrete examples?
Absolutely. Honesty means being truthful in all of your business dealings. From your marketing materials to your financial statements. It means not making exaggerated claims about your products or services, not misleading customers about pricing or terms, and just being transparent about your financial performance.
So no misleading advertising or creative accounting. It's about being upfront and honest with our customers, our employees, and even ourselves.
Exactly. Integrity means doing what you say you'll do, keeping your promises, and standing up for what you believe in, even when it's difficult or unpopular. It means not cutting corners, not taking advantage of others, and doing the right thing, even when no one is watching.
So it's about walking the walk and not just talking the talk. Our actions need to be in alignment with our values.
You got it. Fairness means treating everyone fairly and equitably, from your employees to your suppliers to your customers. It means paying fair wages, honoring contracts, and providing equal opportunities for everyone.
So no playing favorites or taking advantage of others just because we're in a position of power.
Exactly. It's about creating a level playing field and ensuring that everyone has a fair chance to succeed. Respect means treating everyone with dignity and consideration, regardless of their position, their background, or their beliefs. It means listening to others, valuing their opinions, and creating a workplace culture where everyone feels safe and respected.
So it's about fostering that positive and inclusive work environment where everyone feels like they belong and that their contributions are valued.
You're exactly right. Responsibility means taking ownership of your actions, both good and bad, and being accountable for the consequences. It means not blaming others for our mistakes, learning from our failures, and striving to do better next time.
So no shirking our duties or passing the buck when things go wrong.
Exactly. And finally, loyalty means being faithful to your commitments, your relationships, and your values. It means standing by your employees, supporting your suppliers, and being dedicated to your customers, even when times are tough.
So it's about building trust and strong relationships that are based on that mutual respect and support.
You're absolutely right. By embracing these ethical principles, entrepreneurs can build businesses that are not only successful but also sustainable and respected. They'll create businesses that people want to work for, buy from, and invest in.
This deep dive into the world of ethics has been incredibly inspiring. It's a great reminder that doing business the right way is not just good for our souls, it's also good for our bottom line.
You're exactly right. Ethical businesses are more likely to attract and retain top talent, build those strong customer relationships, and earn the trust of investors and the community. It's about creating a win-win situation for everyone involved.
So it's a win-win for everyone. Ethical behavior is not just the right thing to do, it's also the smart thing to do.
Exactly. It's about building a business that's not only profitable, but also makes a positive impact on the world.
This has been a fantastic deep dive into the world of ethics. I feel inspired to lead my business with integrity and to make ethical decision-making a cornerstone of my company culture.
That's wonderful to hear.
Yeah.
Remember, ethics are not a one-time event or a checklist to complete. They're an ongoing journey that requires constant reflection, self-awareness, and a commitment to doing what's right, even when it's difficult.
Okay, now that we've explored the importance of ethics, I want to touch on one final topic that can be a bit daunting for entrepreneurs, but is so important for the long-term success of their businesses. Succession planning.
Succession planning is often overlooked, especially by entrepreneurs who are just starting out and are fully immersed in the day-to-day challenges of building their businesses.
It's like thinking about retirement when you're just starting your career. It seems so far off that it's easy to put it on the back burner.
That's a good analogy. But just like planning for retirement is important, even when you're young, thinking about succession is crucial for any business owner, regardless of how long they plan to stay involved.
Okay, let's start with the basics. What exactly is succession planning?
Succession planning is the process of identifying and developing potential successors for key leadership roles within your business. It's about ensuring a smooth transition of leadership when the time comes for you to step down, whether due to retirement, illness, or other unforeseen circumstances.
So it's like creating a backup plan for your business's leadership. It's about making sure that the company can continue to thrive even if something happens to the founder or key leaders.
Exactly. It's about minimizing disruption, ensuring continuity and safeguarding the future of your business.
I can see why this is so important, especially for small businesses, where the founder or owner is often heavily involved in every aspect of the operation.
You're exactly right. In many small businesses, the owner's knowledge, skills, and relationships are essential to the company's success. So if that owner were to suddenly become incapacitated or decide to retire without a plan in place, it could create chaos and potentially jeopardize the entire business.
Okay, I'm convinced. Succession planning is definitely something that I need to prioritize. But where do we even begin? It seems like such a daunting task.
Don't worry, it's not as overwhelming as it might seem. The first step is to identify those key leadership roles within your business. Who are the people who are essential to the company's success? Who has the knowledge, the skills, and the experience to lead the business? What would happen if they were suddenly gone?
So we're not just thinking about specific individuals, but rather the roles themselves and the critical functions that they perform. It's about making sure those functions can continue uninterrupted, regardless of who's filling the role.
Precisely. It's about identifying those essential pieces of the puzzle and making sure there are backup pieces that are ready to fit in if needed.
Okay, so we've identified those key roles. What's the next step in the succession planning process? How do we find and develop those future leaders?
The next step is to develop a plan for identifying and developing those potential successors for those roles. This might involve creating a formal mentoring program, providing leadership training opportunities, or even having them shadow those key leaders to gain firsthand experience.
So it's about investing in our people and giving them the skills and the experience they need to step into those leadership roles when the time comes.
Exactly. It's about creating that culture of leadership development and empowering your employees to grow and advance within the company.
Now, I know we're focusing on internal succession planning, but are there situations where it might make more sense to look outside the company for a successor?
Absolutely. If your business is facing significant challenges or is entering a new phase of growth, it might be necessary to bring in someone with specialized skills or experience that you don't currently have in-house.
So it's about finding the best person for the job, whether they're already part of the team or not. The priority is to ensure the long-term success of the business.
Exactly. The goal of succession planning is to find the best possible leader for each role, someone who can guide the company into the future and continue its legacy of success.
This is all making me think about the importance of company culture. If we want to attract and retain that top talent and create a pipeline of future leaders, we need to have a strong and positive company culture.
You're spot on. Company culture plays a crucial role in succession planning. If you have a culture that values employee development, promotes from within, and encourages innovation and collaboration, you're more likely to attract and retain those talented individuals who are eager to step up and lead.
So succession planning is not just about finding the right people. It's also about creating the right environment for those people to thrive and grow.
Exactly. Succession planning is a holistic process that involves people, processes, and culture.
This deep dive into the world of succession planning has been incredibly insightful. I'm starting to see how planning for the future, even when we're busy building our businesses in the present, is essential for that long-term success.
You're absolutely right. Succession planning is not a luxury, it's a necessity for any business that wants to create a lasting legacy.
Well, this has been a truly fantastic deep dive into the world of entrepreneurship and finance. We've covered so much ground, from deciphering those sometimes intimidating financial statements to understanding cash flow, financial ratios, and even the importance of ethics and succession planning. I feel like I've gained a whole new level of understanding and confidence when it comes to managing my business and making those smart financial decisions.
I'm so glad to hear that. Remember, financial literacy is a journey, not a destination. It's about continuously learning, asking questions, and seeking out the knowledge and resources that you need to succeed.
Any final words of wisdom for our listeners before we wrap up this episode?
Never stop learning. Embrace challenges as opportunities for growth, and surround yourself with a team of trusted advisors who can support you along the way.
That's great advice. And remember, financial statements are not just numbers on a page. They're a reflection of your business's health, its potential, and its story. Learn to read that story. Use it to make those informed decisions, and never be afraid to seek out expert guidance when you need it.
Happy diving, everyone!